South Korea has just suffered one of the most violent stock market reversals in its history. But I don't think Korea is the biggest financial story developing in Asia. Korea is showing us what happens when an AI boom becomes overcrowded and over leveraged. Japan is attempting something potentially far more important. It's trying to reverse more than 30 years of financial policy without destabilising its currency, its government bond market, or the enormous amount of Japanese money invested around the world. And that means Japan may be about to change the flow of global capital. Welcome back to the channel. This is the channel where we look beyond the daily price action and explain how macro, markets, and crypto connect. I'm Paula, and today we need to talk about what's changing inside Japan's financial system, why South Korea's stock market fall is part of the warning, and why the consequences could eventually reach markets everywhere. Let us begin with Korea, because that's where the most visible damage has occurred. South Korea's Kospi fell almost 11% in one session on the 28th of July, with Samsung Electronics and SK Hynix at the centre of the selling. The market then experienced another highly volatile session as leveraged positions continued to unwind. Samsung and SK Hynix had become enormous expressions of the artificial intelligence investment boom. Both companies are central to the memory chips used in advanced AI infrastructure. The businesses themselves remain important and profitable. The problem was that their shares had become overcrowded, highly valued, and surrounded by borrowed money. Retail investors had used margin and leveraged single stock products to increase their exposure. When the shares fell, those products and margin positions created more selling, which pushed prices lower and triggered further liquidations. At the same time, investors have begun questioning whether AI infrastructure spending can continue at its current rate and whether growing Chinese competition could eventually weaken the extraordinary pricing power enjoyed by Korean chip makers. That does not mean the AI boom is finished. It means expectations have become so high that even a small increase in uncertainty caused a major repricing. But while Korea shows us the danger of concentration and leverage, the more consequential financial change is happening in Japan. For decades, Japan operated a very unusual economic model. Interest rates remain close to zero. The Bank of Japan bought enormous quantities of government debt. Bond yields were deliberately suppressed, and the yen was generally allowed to remain weak enough to support exporters. Because Japanese bonds offered such low returns, Japanese pension funds, insurers, banks, and private investors sent a huge amount of capital overseas. They bought American government bonds, European debt, global equities, and other foreign assets. Japan effectively became one of the world's greatest exporters of capital. That system helped the Japanese government borrow cheaply, despite carrying one of the largest public debt burdens in the developed world. It also supplied global markets with a persistent source of investment money. But that system is now being forced to change. The yen has recently weakened beyond 163 to the US dollar, taking it to the lowest level in roughly 40 years. Japan has already spent heavily intervening in the currency market, but those interventions have failed to produce a lasting recovery of the yen. A weak yen was once viewed mainly as an advantage for Japanese exporters. Today, it's becoming a political and economic problem. Japan imports most of its energy. Oil and many other commodities are priced in dollars, so when the yen weakens, Japan has to spend more of its own currency to purchase the same energy. When oil prices rise at the same time, Japan is hit twice. That raises transport, food, electricity, and business costs. It reduces the spending power of households and squeezes companies that cannot pass every increase onto their customers. Japan's government has now reduced its forecast for real economic growth in fiscal 2026 from 1.3% to 0.9%, while increasing its inflation forecast from 1.9% to 2.2%. Higher energy costs are expected to weaken both household consumption and corporate investment. Japan is therefore facing slower growth alongside continued price pressure. and that puts the Bank of Japan in a difficult position. The Bank of Japan has already raised its policy rate to 1%, its highest level in more than 3 decades. Markets now expect further increases as the central bank attempts to stop inflation expectations from becoming embedded and prevent the yen from weakening further. But Japan cannot simply raise rates until the currency recovers. Its government debt exceeds 200% of GDP, and the entire financial system has spent decades adapting to exceptionally low borrowing costs. Japan's 10-year government bond has already approached 2.9%, its highest level in 30 years. Longer dated yields have also climbed as investors demand more compensation for inflation and fiscal risk. Japan's finance ministry used an interest rate assumption of around 3% when calculating parts of its fiscal plan. If borrowing costs move materially beyond that, debt servicing expenses rise and there is less money available for everything else the government wants to do. That creates a contradiction inside Japanese policy. The Bank of Japan needs to raise rates and reduce bond purchases to control inflation and rebuild confidence in the yen. But higher rates and reduced central bank bond buy-in places more pressure on government finances and the bond market. If bond yields rise too quickly, the Bank of Japan may be pushed into buying more government bonds again to stabilise the market. But buying more bonds would inject liquidity, hold yields down, and potentially weaken the yen. The exact opposite of what the central bank is trying to achieve. Japan could find itself raising short-term interest rates with one hand while supporting the bond market with the other. That is the real policy trap. It's not simply about whether interest rates rise by another 0.25%. It's about whether Japan can remove the financial support it's provided for decades without discovering that the system can no longer function normally without it. The policy situation makes this even more complicated. The Prime Minister wants to stimulate growth through tax reductions, state support, and enormous investment in strategic industries. Her economic blueprint proposes more than 370 trillion yen of combined public and private investment through 2040, including investment in industries Japan considers strategically important. The government is also moving ahead with a temporary reduction in the sales tax on food, cutting it from 8% to 1% for 2 years from April 2027. The aim is to help households struggling with the rising cost of living, but markets are asking how these plans will be funded without creating additional pressure on government borrowing. The government says growth and stronger tax revenues can fund its plans. Bond investors are not entirely convinced. This means fiscal policy and monetary policy are pulling in opposite directions. The government wants to support spending, investment, and economic growth. The Bank of Japan needs to control inflation, support the yen, and demonstrate that interest rates are no longer permanently trapped near zero. Even the wording of the government's economic plans has caused concerns over whether policy leaders might attempt to influence the Bank of Japan and delay further rate increases. Japan eventually revised the wording to emphasise the central bank's independence. And that brings us to what I think is the most interesting and underappreciated part of this story. Japan may be preparing to call some of its money home. Japan held approximately 562 trillion yen, around $3.5 trillion in overseas assets at the end of 2025. Its government pension fund, the largest pension fund in the world, controls around $1.8 trillion in total assets and has approximately $930 billion invested overseas. Japan's finance minister has now encouraged the fund and other Japanese institutions to increase their investment in domestic assets. Analysts estimate that even a shift within the pension fund's existing investment ranges could redirect around $80 billion from foreign bonds into Japanese government bonds. That wouldn't happen as one enormous sale. It would probably occur gradually as foreign bonds mature and the money is reinvested inside Japan. But the direction matters. For years, Japan pushed money out into the rest of the world because its own bonds offered almost no return. Now, the Japanese bonds are offering their highest yields in decades, and the government actively wants more capital invested at home. That is not merely a change in Japanese pension policy. It could represent the beginning of a reversal in one of the world's largest cross border capital flows. If Japanese pension funds, insurers, and banks gradually buy more domestic bonds, they may purchase fewer US treasuries and fewer foreign assets. Japan is not about to sell everything it owns abroad. Japanese institutions still require diversification, and much of this adjustment would take years. But global markets are priced at the margin. The question is not whether every Japanese investor leaves America or Europe. The question is whether one of the world's most dependable sources of foreign demand becomes slightly less dependable. Japan has spent years helping finance other countries' bond markets. It may now need that money to finance its own. This is where the Korean story becomes relevant again. Korea is experiencing a violent reversal in an AI-led stock market at the same time that Japan wants to direct more domestic capital into strategic industries, including technology and advanced manufacturing. Across Asia, governments want greater financial independence, stronger domestic investment, and less reliance on foreign technology. But they're attempting to make that transition while currencies are under pressure, energy costs are elevated, and investors are becoming less willing to pay any price for the AI story. Japan is not just adjusting interest rates, it's trying to change where its savings go to, how its government is financed, and which parts of its economy receive capital. The yen carry trade is one potential consequence of this change, but it's not the whole story. Yes, higher Japanese rates or a sudden strengthening of the yen could force some investors to close leveraged positions funded in yen, but the slower and potentially more lasting change is the redirection of Japanese capital. Less Japanese money flowing abroad could mean less demand for foreign government bonds, upward pressure on global yields, and tighter financial conditions, even without a dramatic market crash. For crypto, that matters because Bitcoin and the wider market remain highly sensitive to global liquidity and the cost of capital. If Japan raises rates, allows domestic yields to rise, and redirects capital home, global liquidity could tighten. That would generally create a more difficult environment for highly leveraged risk assets. If the Japanese bond market becomes unstable and the Bank of Japan is forced to restart aggressive bond buying, the opposite problem could appear. That could weaken the yen further, increase imported inflation, and renew concerns about the long-term value of fiat currencies and government debt. A hard asset such as Bitcoin could eventually benefit from that story, but a disorderly event would probably produce selling and deleveraging first. The order is important. Financial accidents are normally negative for markets before the policy response becomes supportive. And when markets are this unpredictable, emotional decision making becomes one of the biggest risks for traders. It's one of the reasons some traders choose to automate part of their strategy using predetermined entries, exits, and risk settings rather than attempting to react manually to every sudden move. Automation doesn't remove risk or guarantee profits, but it helps traders follow a defined system. It's exactly the reason why we've created a completely free course showing you how to automate some of your trading. It's called the TradeBot Pro course, and it explains how automated trading works, and it shows you how to set it up step by step. I've linked it in the description below if you're interested to find out more. So, what should we be watching next? The Bank of Japan's message following its meeting on the 31st of July will be important, but I'll be listening for far more than another discussion about the next rate increase. Does the bank believe inflation is becoming persistent? How concerned is it about the weakness of the yen? And what happens if government bond yields break decisively above 3%? I'll also watch whether the government continues pushing pension funds and other institutions towards domestic assets, because that may tell us whether Japan is merely trying to stabilise its markets or is genuinely beginning to reverse decades of overseas capital investment. Finally, watch the disagreement between the government and the bond market. Japanese leaders believe investment, tax cuts, and economic growth can make the debt manageable. The bond market is beginning to demand evidence. That's why I think Japan is the bigger story. South Korea is showing us the immediate danger of excessive concentration and leverage. Japan is dealing with something deeper, a financial system designed around near zero rates. Central bank bond buy-in and the export of Japanese savings is being forced to change. Japan now needs higher interest rates to protect its currency, lower bond yields to protect its government finances, fiscal support to protect its households and domestic investment to rebuild economic growth. It cannot maximise all four at the same time. Eventually, something has to give. Japan may manage this transition gradually, capital may return home slowly, bond yields may stabilise, and the Bank of Japan may continue raising rates without creating a major shock. But if that balance fails, the implications will extend far beyond Japan. The world has spent decades benefiting from cheap Japanese money and enormous Japanese overseas investment. The biggest question is what happens when Japan decides it needs more of that money for itself. Let me know in the comments whether you think Japan can unwind this system gradually, or whether its bond market is becoming a much bigger global risk. And if this video helped you understand what's changing beneath Japan's financial system, please like the video and subscribe to the channel. Also, if you see the hype button, please press it. It really helps the channel grow. At the moment, Korea may be producing the biggest market headlines, but Japan could be quietly changing where trillions of dollars flow next. Thank you so much for watching, and I'll see you in the next one.